You are about to hand the Australian Taxation Office a massive portion of your hard-earned wealth, and you probably do not even realise it. If you are over 45 and your super balance is sitting in a standard industry fund without a high-level strategy, you are essentially volunteering to pay more tax than the law requires this June. Welcome to Aussie Super Secrets. Today, we are pulling back the curtain on the elite wealth secrets used by high net worth couples to shield over $850,000 within the institutional safety of industry funds. I am going to show you exactly how to secure a $12,450 tax saving before you file your next return, but more importantly, I will reveal why your current default settings are a slow-motion train wreck for your retirement balance. Stay tuned, because at the end of this video, I will reveal the absolute worst thing the ATO can do to your contributions if you miss a single deadline by just 24 hours. It is a mistake that costs high-income earners thousands every single year. But before we dive into the mechanics of these elite strategies, I must provide this essential notice. This is general information only, and does not constitute personal financial, taxation, or legal advice. Always consult with a licensed financial advisor or qualified accountant before making significant moves with your capital. Let us look at the current landscape for the 2025 to 2026 financial year. We are currently in a high-stakes environment with the Stage 3 tax cuts fully in effect, which has shifted the goalposts for tax minimisation. For those of you earning over $190,000, you are hitting that 45% marginal tax bracket plus the 2% Medicare levy. This means for every extra dollar you earn, the government is taking nearly half. However, the law provides a powerful escape hatch through concessional contributions. The annual cap has now moved to $30,000. If you are a couple, that is $60,000 of income you can protect from those high marginal rates, taxing it at only 15% inside the fund instead of 47% in your pocket. Think about the math for a moment. By maximising that $30,000 cap, you are effectively creating a tax arbitrage of 32%. On a full $30,000 contribution, that is a literal cash saving of $9,600 in tax that stays in your family's ecosystem rather than going to Canberra. But do you know the absolute worst thing the ATO can do to you? We will see that in a second, because it involves the timing of your transfers. Now, for our high flyers earning over $250,000, we have to talk about the Division 293 tax. This is where the ATO tracks you down for an additional 15% tax on your super contributions because they deem your income too high. Many high net worth individuals think this is unavoidable, but there are tactical ways to manage your reportable income to stay below or mitigate the impact of that $250,000 threshold. Consider Sarah, a senior executive earning $240,000. By strategically using salary sacrifice to lower her taxable income while staying within her concessional caps, she can manage the effective cost of her contributions. If you do not account for Division 293, you might find yourself with an unexpected tax bill months after you thought your EOFY was settled. The next layer of protection involves what we call the catch-up or carry-forward provisions. This is the most underutilized weapon in the Australian tax system. For those with a total superannuation balance, or TSB, of less than $500,000, if you haven't maximised your caps over the last 5 years, you can reach back and use that unused space to make a massive lump sum contribution this year. We have seen couples with $850,000 in combined balances use this to wipe out their entire tax liability for a high-income year. Imagine being able to inject $50,000 or $60,000 into your super in a single hit, all while claiming a full tax deduction. It is a legal goldmine, but it requires your TSB to be under that $500,000 mark at the 30th of June of the previous year. But here is where most people fail. They trust their industry fund's MySuper default option. If you have a balance of $300,000 or more, the percentage-based fees in a default MySuper option can be predatory. You need to look at choice or member direct investment options within funds like Australian Super or Australian Retirement Trust. These options often come with admin fee caps. For example, some funds cap their administration fees at $500 or $600 per year regardless of whether you have $200,000 or $2 million in the account. If you are still paying a percentage-based fee on a high balance, you are bleeding thousands of dollars in lazy fees that could be compounding for your future instead. This leads us to a critical warning. I call it the BPAY death trap. Listen closely, because this is where the most disciplined investors lose everything at the last minute. The ATO does not care when you clicked send on your bank app. They only care when the money is received by the fund. If you send a $30,000 contribution via BPAY on the 28th of June, and it takes 3 business days to clear through the banking system, your fund might not receive it until the 2nd of July. In the eyes of the ATO, you have missed the deadline. You lose the tax deduction for the 2026 financial year, and you might accidentally blow your cap for the following year. You must ensure your transfers are initiated early in June to account for these clearinghouse delays. As we approach the climax of this strategy, please remember, this is general information only and does not constitute personal financial, taxation, or legal advice. You should seek independent advice from a qualified professional before making any investment decisions. The final secret to protecting a large balance inside an industry fund is understanding the transfer balance cap and how it interacts with your accumulation account. As your balance grows towards the $1.9 million mark, the strategy shifts from how do I get money in to how do I keep it there tax-free. By maximising your concessional contributions now, and utilising the bring forward rules for non-concessional contributions, which allow you to put in up to $360,000 over 3 years depending on your TSB, you are building a tax-sheltered fortress. Now, for the revelation I promised. What is the absolute worst thing the ATO can do? If you exceed your caps and do not handle the excess contributions notice correctly, the ATO can tax that excess money at your highest marginal rate plus interest penalties. They essentially strip away all the benefits of super and add a fine on top. They do not just take the tax, they take the growth potential of that money forever. You have worked too hard to let poor timing or default settings erode your wealth. The clock is ticking toward June 30th. Ensure your contributions are received, your investment options are fee capped, and your carry-forward amounts are calculated to the cent. If this deep dive into high net worth super strategy helped you realize how much you could be saving, then you cannot afford to miss our next episode. This Thursday at 7 p.m, I will be exposing the hidden retail fund fees that are quietly draining the accounts of Australian executives. Subscribe to Aussie Super Secrets right now to make sure you never regale a single cent more to the ATO than necessary. I will see you in the next one. Disclaimer: the information provided in this video is for general educational purposes only and does not constitute financial, taxation, legal, or home loan advice. It has been prepared without taking into account your personal objectives, financial situation, or needs. Before acting on any information, you should consider its appropriateness and consult with a licensed professional, such as a financial planner or tax agent. Specific results or future performance are not guaranteed. Copyright symbol 2026 Aussie Super Secrets. All rights reserved.